in the media identified above. By accessing this webinar, you will be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic. All right, so what's going on today? In the bigger picture, this is 5 minutes, it doesn't help hourly. All right, so we're at the top of the ranges again. So we went flying up. This is basically when Powell started speaking and saying he's got everything under control. Don't worry, everything's going to be great. And everyone's taking that kind of to heart, and we're back up testing the highs. Once again, we were briefly over 2,200, but it failed on the Russell today, so that's kind of interesting. Energy shot up as well. Gasoline went flying higher. It's going to be fun at the pumps. Natural gas went crazy. That is a huge move. We got an 11% move today in natural gas. And we're up from 4, it's 20% in 2 days. And we're up from 4 to 470 something. So that's nice. And we played natural gas long last week, so that was very good. Also, we have it, I think, in the short-term portfolio. Oh, yeah, look at this. Look at the long-term portfolio. Holy crap. 380% now in the long-term portfolio. That is insane. And that's $2.4 million. Obviously haven't touched it since last week. I haven't even been here. That's just some crazy, crazy stuff. And so I think that's up another. I think that's. I don't remember, frankly. I think it's like up 100,000 from last week. This is just ridiculous. And these portfolios are gaining at a huge clip. Now, of course, the short-term portfolio is taking a hit. It was down 14%. Nope. Oh, that's weird. I don't get that. I don't know how the short-term portfolio can be making money. That's weird. So the short-term portfolio didn't lose money. It's at $200,000, which is basically where we effectively started with it. We didn't really, though. What happened, the short-term portfolio is it made a ton of money when we started because the market dipped very quickly. We put some of that money into the other portfolios so that they could obviously rebound. You know, we put more money into other stocks at the bottom so they could rebound. Then the market tanked, went the other way and flew higher. The short-term portfolio was down 50%. So we took $100,000 from the long-term portfolio and put it in the short-term portfolio. So that then is where we are with that. So when I do that, we call the basis. Now, see, I should have done the other way though. We call the basis the more money. So when I put the money in, we count that as being a higher basis, even though oddly enough, when we take it out of the long-term portfolio, we don't count that as a lower basis because that's just taking the profits out. I don't know. Not sure what the proper thing to do would be there, but just so you know, that's where it comes from. So when we put 200,000 into the portfolios, we count that as having a higher. We count that as adding to our cost basis. But the cash that we take from the cash, we don't detract that from our basis, so it doesn't change anything. So it was kind of a wash because first we put money out of the STP, then we took some money back. But that's how you want to manage it anyway. That's the correct way to do it. It's just, you know, that's the point of hedging with the portfolios. When one is down, the other's up. So you take some money from one, put it into the other, then goes the other way, and take the money, move it over. We recently deployed some more money to get a bit more bearish. Oh, that's not actually reflected yet. The change that we made isn't reflected, but it should have a big effect. I thought we'd be down much more than that, so I'm surprised. So that means now this is really crazy because if we go back, when would our last review of the long-term portfolio have been? That would have been, nope, it would have been after the 14th. Would have been here, 17th. Here it is. So we had $2.2 million on December 16th in a long-term and short-term portfolio combined. That's the two of them together. and it was probably 100,000 in the STP and 2.1 in the long-term portfolio. The long-term portfolio has since gained, well, the short-term portfolio has gained $100,000, and the long-term portfolio has gained $300,000. Right, 2.4. So now it's 2.6 total, and we've never had this much before. This is crazy. Yeah, so we're at 400,000 total dollars since December 16th, which is only about even a month ago. I really struggle with, like, it's like, why are we not cashing out? It's very hard to justify. The more money we get, the harder it is to justify not cashing out. This is so unlikely of a turn of events that everything we did is everything we picked is working, or the vast majority. So what's been happening since December 16th? Wow, hours. No, that's not, nothing's capturing. So December 16th was down here. Well, that's one thing, is we were at a low point. So when we did that review, what day is this? 21st, 17. Wasn't that bad. All right, the 16th. The 16th was the beginning of this downturn here. We're not that far off it. We had some violent times, but we're not that far off it. But apparently the adjustment, between the adjustments we made, which weren't that many, and mostly it's a short-term portfolio coming back $100,000, but the long-term positions gained a lot. We hit the January expiration. That's a big factor, though. We sell a lot of January short puts and calls, and the last couple of months of expiration is when they lose all the rest of their value, if they're out of the money, or even if they're in the money, they lose all of their premium into obviously the January close. So every year in January we do really well. That's normal, because that's when all these calls and puts expire that we sold a couple of years ago. And even if they're doing well, they always hang on to like too much value towards the end. They're always like overpriced at the end, right? And you have to wait until they expire. So these are good months for us, and we have sold a ton of premium in these portfolios. And the portfolios are getting huge. That's the other factor, is because the portfolios are so big, a huge amount of things are expiring, including, I think, a lot of puts. So we've got, well, that's 2023, 2022. Wait. Oh yeah, that is this year, 2022. See, those already expired in December 2023. Nope, I guess we purged all the 2022s already, so I'm wrong. But anyway, so everything, but obviously all the short puts we buy are almost all January something, either 23 or 24. And so many of these positions, we're going to have a lot of work to do on this, because so many positions are January puts and calls that now have to be adjusted. And you can't just, take the money and run. I'm going to be tempted to cash out a lot of stuff now, because this is silly. This is it's just ridiculous to be up this much and to make this much money. You're not going to just keep making $300,000 a month. That's not possible. It was only a $2 million portfolio at the beginning of the month. So how are you going to make $300,000 a month? How are you going to make $3 million a year on a $2 million portfolio? It's ridiculous. Clearly, we've had a good run. We had a lucky streak. When you have a lucky streak, you got to take it off the table. So we have to go through these things very, very carefully and see like which ones we can purge and drop back to cash, and especially reducing the risk of a downturn. Now, on the other hand, though, we have an insane amount of hedges now in the short-term portfolio. We are hedged for like, $600,000-$700,000 of downturn. So we are really well protected. So, to some extent, it's going to go back to watch and wait, but I'm going to be very critical about pulling stuff off. Before we buy new things, I'd like to see what we can get rid of. So here, anybody who's up, he's up 100%, so forget that. Anybody who's up 60%, which is only this one, which is only BC Barclays. So anybody up that much where there's only 35% left to gain between now and between now and a year's 373 days. Is that worth keeping? Well, the thing is that we're pretty confident in them and it's not a problem. So, and it's only 1450. So frankly, for 1450, I'm not going to get rid of that either. You know, he's up 50%, but he's got a year to go. That's normal. 30, 30, 30, 20, 20, 20. 45 with 2 years to go, he's ahead of schedule. 45 with 1 year to go is fine. 25 with 2 years to go. 33, these are all right on track. Oh, Moderna, we're certainly going to do something about Moderna, which is basically roll. Well, we're going to roll for more is what we're going to do with Moderna. Oh, here's Labor. Somebody's just talking about, is it time to get into Labor? We already made that decision. We sold the $30 puts for $7. So we put our foot down at 23. Now it's down to 27. That's the funny thing about options though. These guys, these puts are not in trouble. Lebu is at 27. We sold the $30 puts for 7. So if it closed today, this is net 3, and we would make money. But instead, they're priced at 1170. They have crazy pricing, and so we're showing a 67% loss, even though we're fine with where we are now. And that's one of the things you have to learn to fight your instincts on these things, because it's not, you don't go, oh my God, I'm losing 67%, I got to pull the plug. Same thing with Moderna. It's like, that's why we only sold 5. We weren't sure where the bottom was going to be. But we sold the $200 puts for $25. Our net entry is 175, right? But this thing is telling us that we're losing money. You got to think for yourself. You can't just go by what the broker screen tells you. And yes, if you cash it out, you lose. But that's the only way you lose, is by cashing it out. It's basically just trying to scare you out of your position. How is this a problem? I sold the $200 puts. It's at $225. I sold those puts for $25. So it has to go to 175 before we're losing money. It's at 225, and you're telling me it's $50 for that put? So what's my answer? Can I sell more? Thank you, sir. May I have another? Not, oh my God, I got to get out of this position. I'm down 100%. It's like, holy shit, they'll pay me $50 now to sell more of those? And I don't want those. Well, actually, this is 2024. No, probably that is where we want to be. I think that's a perfectly good spot. Let me get back to I want to find those long charts. My favorite chart, and for a while you couldn't pick it up on FinViz, and now it's back. I think I have them. There you go. Oh, I love it. Oh, and look at that, it's labeled. Open it, new tab. So it wasn't labeled we were looking at, though, was it? It was Moderna. All right, so we don't know. That 200 was my judgment call to say this is where I want to make a stand. We did that a while ago, obviously, and so far we're down 100%. When did we do this? 10-5. So, nope, there. So in early October, I said we'll pay 175 for this. That was my call. And this is when we sold these for $25. So now we are $75 below that price, and those have gone up 50. Those have gone up 25 against us. So that's fair. There's nothing unfair about this situation. But what do we want to do for a roll? So we look at Moderna and say, well, this is an opportunity. And we go to, oh, I see things are turning down a little bit. So we have the 200 puts at a $50. And so the question is, do we want, now there's two things we could do. We could roll down and sell 2 times the 150 puts. And what that would do is, and so we'd sell 10 150 puts instead of 5 200 puts. And what that would do is just knock our cost basis down from 175 to, instead of 25 that we sold the original set for, it's 1250. So it'd be 187.50 would, I'm sorry, not 187, 137.50 would be our new cost basis. But that would be our cost basis on 1,000 shares versus 500 shares at 2. So we would go from 100,000 to $137,000 commitment, but our commitment would be to buy 1,000 shares at 137.50 versus 500 shares at $200. So everybody clear on that? So it would not help us margin wise, although well, in a portfolio margin account, it will help you because if you're 20% out of the money, your margin goes down to practically 0. So being 20%, pushing ourselves out of the money would help with margin, as opposed to right now, they count on a 20% drop. So basically they'd be taking like $45 off. So we'd be at like 180. And that means that the $200 puts would be hitting us for 20 bucks a piece. So right now, those puts are $10,000 in margin. All right, and I think we can see that if we try to sell them, single 5 of them, right? So sell 5, buying power effect $7,000. Yeah, so in a portfolio margin account, your buying power effect is going to be $5,000. It's going to be less than $10,000 or around $10,000. But if I did the same thing here with the 150s and I sell those, confirm it's in. Oh, buying power effect is $10,000. No, so it doesn't help. It should help. I don't know why it doesn't. But anyhow, so if your margin account is working that way, you can benefit from pushing it down to a lower strike. But if it's not working that way, and it may be that Moderna is so volatile, they've increased the margin requirements. But anyway, that's one factor. But the other factor is just a basic price. You're more comfortable owning Moderna at 137 than you would be at 200. That's not the case with us. So frankly, especially in a $2.5 million portfolio, we got no problem owning 1,000 shares of Moderna for $200. We don't think that's going to happen, and then we would roll down and do something about it. But I think at this price, I'm pretty damn comfortable selling more. But that doesn't mean you don't want to look. The 180 puts of 40 bucks. Is that better? Is it worse? You know, you're gaining traction because that's net 140 and we're in for net 175. So we're going to sell for 40 more. I think probably that might be smarter. So we take our short puts that we have now that are $25,000, and instead we sell 10 of these for $40,000. So we pick up $15,000. So in other words, we roll from here, from the 200s down to the 180s, and we add, so we're selling twice as many, pick up $15,000 in cash, and we lower our strike from, oops, wait, because it's 10, so it's only, I'm sorry, we only sell them for, oh my God, is that complicated? We get $15,000 more dollars, we're selling for 20, and the net is 160 instead of 175. So we're dropping our net to 160 from 175, and we're adding, now we're committing to 1,000 at 160 instead of 500 at 200. I think on the whole, though, that's probably a good compromise thing. I really don't see why Moderna should be knocked down like this, but it seems like a good play to me. But we'll see. We'll make that decision as we see how the market goes. You know what? That's the other thing. There's no emergency to these things. It doesn't matter, because what's going to happen? It's either going to go down lower, and that means we're going to get a better roll. Yeah, we're going to lose more money, but we're going to roll anyway, so we'll get a better roll if it goes lower. So that's not really an issue for us. So there's no reason not to wait. Or it goes up, and then we don't have to roll at all. Everything's fine. So there's no absolutely no hurry. And that's really important also when you're making a bid for these things. You have to realize it's not an emergency, so wait. There's no downside to not getting, in other words, if I can't sell those if I can't sell these for $40, the 180s, and the spread is 36.43. So if I can't sell them for $40, I'm not interested. What is this net change? Who cares about the net change? Delta. Not the delta, the last. There you go. There you go, 39.30. So if I can't sell them for $40, I'm not interested in selling them. I don't need to sell them. It's fine. I've got perfectly functional ones. So, and also again, like I said, since we're net 175 and this is at 225 right now, if it goes higher, then we've got no issue. Even though it says we're down 100%, it's never going to be an issue because it's going to expire worthless. So unless it goes lower and it triggers my sale at $40, I have nothing to get out of. And a lot of people don't really think about that when you're initiating your options and you're buying into your spreads. You really have to think about, why am I doing this? Each leg, you should be thinking about, what is the purpose of this leg and how badly do I need it right now? Because almost any stock is going to go up and down over time. There's very few things you're going to buy that aren't going to give you multiple entries. I mean, look at this stuff. Look at this, down, up, down. I mean, went completely through. So if you started here, whatever price I ask for on the top or the bottom. So if I want to ask for extra money for my puts or extra money for my calls when I'm selling them, at this decision point here, all I have to do is put in a bid for both, and they both eventually fill. These are huge moves. This is $50. This little line here is $50. So it goes up like $75 here. It goes down $100 here. So no matter what number I would have said here and you say, oh, that's too greedy, it'll never fill. Yeah, it filled. Very, very few things go in such a straight line that you're not going to get your fills. Now, I'm not talking about crazy fills. I'm not saying it's at 40 now and ask for 50. But I'm saying when the bid and ask spread is 36 to whatever it is. When it's 36.42 or 37.43, basically, when the bid and ask is 37.43, it's not outrageous to ask for 40. In fact, it's crazy not to. You should always be able to get the middle of the spread. It's the chance of not being able to get that over the course of the next few days is very slim. Yeah, sometimes you're going to be out of luck. Keep that in your head too, though. What's going to happen in the next few days? It's going to cause me not to be able to get my Moderna at that price. Does Moderna have any news coming up? Is there anything pending from them? Is there a biotech conference? Is there some announcement coming? Is there earnings going to be coming around? Is the Fed making an announcement that can move the whole market? If there's volatility of the market in some major way that can knock it out, then you might want to get in quickly. But otherwise, you got all the time in the world to make these fills. And if you don't make the fill, all you do is say, okay, what do I have now? And let's work with that and adjust based on where we are now. It's never an emergency to take a price. You should never feel pressured to take a bad price in the options. It makes such a difference in your overall trading. Especially if you got a portfolio with a lot of positions, it's something you should practice, basically. It's like something you should always be trying to get a better price. You should always see how great a price can I get when I want to set something up. And when I put up prices, when I talk about a trade, I'll usually go smack in the middle, but I will always put a price I think is reasonable to get. And it's very, very rare that we don't hit those prices. In fact, the main reason we have trouble with those prices is a lot of you guys jump in and do it too early. I see it happening. I see everybody jumping in and taking a trade, and people are too willing to take a lower price. But then you just got to wait a couple of days, and then it normalizes out. That's something with those Kramer stocks you can really take advantage of, because those people overpay like crazy. He rushes people in and out of stuff, and they just go nuts and push into it. And speaking of overpaying, we were just discussing this in member chat. Yeah, 8800 was asking me about Costco and BJ's and whatever, and those guys in Europe. And you know, these are the charts. This is Costco above and BJ's. I'm not a chart person, and frankly, it was the last thing I looked at. But when you look at the chart, this is a 2-year chart. Look at a chart, and you see this 300, and now it's it just came off of 550, but now it's 527. And BJ's was 20, and now it's 60, 65. I've already lost interest. On the chart alone, I'm like, I missed it. It's over. I need to find something that I didn't miss. I missed this. Would have been a great buy at the beginning of the pandemic. And frankly, I'm surprised because I would have not, well, I didn't. We looked at these and thought about them back in the pandemic, and I didn't think you got to go to Costco. You know, it's like you have to go to Costco, you have to go to BJ's. I guess you can, get them online and whatever now. But back in March of 2020, they were not high on my list of things I thought were going to recover quickly from a recession. And in fact, they've done phenomenally well. I did realize that during the pandemic, because people were running to Costco for toilet paper and paper plates and things like that, that was something people were going for. When there were shortages of things, people were going to Costco to get what they could, because Costco was actually doing very well at stocking things back up. If they go, hey, look, if they go on sale, they're a great company, but they're not on sale at all. And so why do I want to deploy my money? Costco is trading like 40 times earnings. BJ is trading at 50 times earnings. I'm sure they're great companies. They do lots of good stuff. They've got fantastic futures, blah, 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 blah. But come on, it's already priced in. You missed the bus, and go, don't walk away. That's what they mean by missing the bus. It's like when you miss the bus and it pulls away from the stop, there's no point in chasing it for the next 5 miles. It doesn't work that way. It's just, you missed it. It's over. Just find some other way to get to the place you want to get to. And a while ago, I can't remember when we did this. I seem to remember being a Tuesday, but we did these picks. Was it like right after New Year's? Let's see. Whoop, was it right after Christmas? Oh dear. I just remember that we had done a whole bunch of Friday, still Merry Monday. Let's see. Remember, I was in a mood to make a watch list. Should be pretty obvious when we get to it. No, that was our trade of the year runners up. Oh, well, that's a good example anyway, though. I mean, here we were, so early December, these were the runners up for our trade of the year, not Apple. Here. So in December, these were the trade of the year runners up. Well, this is the actual trade of the year. This is our trade of the year is IBM. And on December 3rd, this is what we picked. So look at how the chart looked on December 3rd. Okay, this is where I buy. Look at how this chart looked. Intel, December 3rd. Looks like a train wreck. This is where I buy. Altria, look, it wasn't even making a weak bounce. This is where I buy. Walgreens, also down here. This is where I buy. Now, how do I know it's going to bounce here? It looks amazing, right? It's like, oh my God, how did you know that day? How do you say on December 3rd that day? Now, it's because, first of all, December 3rd was a day that the markets had crashed. We had a multi-day crash after Thanksgiving. So I felt that the crash had exhausted itself. Then I go to my list, and we had, because I had been in the process of identifying my trade of the year for the next year, I had a nice list on my desk of all these different candidates. And I was like, oh yeah, that one's good, that one's good, that one's good. And I kept, it's like a Sweet 16 elimination thing. I keep looking at all these different factors, and if one little thing is bothering me, I cross it off. And the last ones I crossed off with these guys was Walgreens, Altria, Intel, and IBM. I think there was one other. I don't remember. Oh well. No, I don't know. Anyway, I thought there were 5. No, there were 4 cents. Okay. So anyway, so these were the final 4, and of the final 4, IBM became the stock of the year. But the point is, I already knew from my research in Thanksgiving that these were my top contenders. Then we had a little sell-off. So I wasn't picking the bottom based on the chart, because the chart looks horrible. I was picking the bottom based on, these are fundamentally where I said these are ridiculously low prices. I'm very happy to buy in here. Now, what was wrong with Walgreens? Nothing much, just the Omicron I thought might close the stores down, therefore didn't become the stock of the year. I thought the value-wise, I thought they were tremendous value. I've been banging the table on these guys for a year. So this was, I thought, just too good not to pick. I call him Philip Morris. Altria. Altria, I think, because of the, they're going to have hemp cigarettes down the road. They're going to have marijuana cigarettes down the road. They got a huge, bright future ahead of them, even if less people smoke. And they're going to be smoking different and more expensive cigarettes, and so on and so forth. And I think there's a huge opportunity for them. The only reason that they've had poor earnings the last few years is they had that complete debacle with the vaping thing. Juul, they bought Juul for like some stupid amount of money, like $12 billion, and it was like a total loss. But the takeaway from that is this company is so rich that they can make a $12 billion mistake, and it really doesn't bother them much. It's like, other than hitting their earnings a bit for a couple of years, a $12 billion loss was just oops. So, going forward, you say, well, if they can just avoid doing that again, they're going to make much more money. It's not a hard concept. So what was my negative on them was just that I don't know when they're going to really put the marijuana legislation in place. I didn't think it was going to happen in 2022, where we're going to nationally legalize it. And until we do that, they're not going to be rolling out any new products. They're waiting for full legalization across the country before they do anything. Because, think about the scope of their operation. They don't want to be messing around with only in this state, only in that state. Plus, they can't do that because their business model is growing centrally, growing in massive farms in the middle of the country and shipping out everywhere. The way the laws are structured now, you have to grow pot in California and sell it in California. You have to grow pot in Michigan and sell it in Michigan. You cannot cross state lines with marijuana. So even from a legal state to a legal state, you can't even go from California to Nevada with marijuana, which is ridiculous. But that's how the laws are set up now. So anyway, lots of potential there. But where's my catalyst? Now, Intel just went through a massive investment cycle, just like Philip Morris, except in Intel's case, it's intentional. They spent a fortune moving to, they don't call it, I forget what it's called now. They don't call it, they don't call them microns anymore. They got a new term for it anyway. But it's these teeny tiny little transistors that they've got now. Their new set of chips. They just finished the fabrication facilities. They're going to start printing them, and once they start making the things, all hell breaks loose with the profitability. It's like when Boeing rolls out a new plane, except with Intel, when they crash, not as many people die. I won't say nobody dies. They were on some pretty critical systems. So, but on the whole, you can, they're basically rolling it out, and this thing's and it's going to go like this. It's just crazy. So this was stupidly cheap. And that's the thing. It's back to the thing I said before. You can't care what the chart looks like. You cannot go by what other people think. Other people are idiots. Okay, most of these people do not know more than you do. Most analysts, and you know this, you hear them on TV, they're not smarter than you. They spend all day and all night looking at one sector or something like that, and they might have an insight of something or other, but they're not smarter people than you are. In fact, a lot of them are complete morons. They just babble on about bullshit that you hear these analysts and you think, what is this person actually talking about? They latch on to like one little thing about something about a product or a company that they like, and they just pump that up and say this is why this is the greatest company on earth, when they ignore all the other factors that are critical to whether they're going to make money or not, like Tesla fans. They're insane people, and so are the analysts that tell you it's worth it. But enough people do it, enough people follow it. So what are you going to do? You can't stop it. So anyway, and then IBM. So IBM, I didn't have any negatives. IBM also coming through an investing cycle. IBM has they've actually given up on the medical aspects of AI. They've given up on the Watson medical stuff. They decided that's just not going to go anywhere fast enough, so they're going to spin it off or do something with it. They've got incredible products coming out. They've got three-dimensional memory chips that are going to increase 1,000 times more memory than you can store currently. They've got quantum computing, which is it's an arms race, and quantum computers, weird as they seem, are going to be the future, and they're going to make. I mean, for one thing, they're going to make all encryption obsolete. Encryption is pointless, or non-quantum encryption is pointless, and therefore companies have no choice but to buy them. Your computer is a completely open book to a quantum hacker. So a lot of new stuff coming out, a lot of big projects in the works. They're leaders in so many different things, and as a base company, and their service division is huge and massive. And when you're in a new implementation cycle with these faster Intel chips and the quantum computers and all the robotics and things like that, it's the IBM consulting division that really shines, their services. And you're going to see just huge things coming out of IBM. And they also, they bought Red Hat for Linux a couple of years ago. And that's huge. And people don't, Linux, again, is the core. Linux is the stepping stone for small companies that don't want to spend money. Get Linux for free, and you say, well, why would IBM want to do that? They sell the expensive operating systems, but what they're really selling you is they get you in the consulting services for Linux, and then they step you up as the company grows. You're working with these IBM consultants, and they then carry you from the Linux system to an IBM OS, and then all of a sudden they're at the growth stage of all these small companies that are moving up, because that's what you do. Eventually, you have to dump Linux and start moving into Oracle and things like that, and the bigger databases. And so IBM is very, very good at transitioning people and helping, and they give you the whole plan. It's fantastic. I mean, they just really know what they're doing. So that was why they bought Red Hat. But then the payoff of that takes years. But they're starting to insinuate themselves into hundreds, thousands of companies that were Linux users, and they've now got their hooks in these guys. And as it doesn't matter which ones, it's like betting on the market, and it's like having a free bet on the market, and some of the stocks are going to take off. The ones that take off, the ones that do good and build themselves up, IBM's in there, and working with them and consulting with them gives them the inside track to get the future business. And the cloud computing. I forgot all about cloud computing is a huge thing for IBM too. I mean, it's crazy. So very, very, very undervalued company, and especially at this insane price of 115. So there was no way I could resist that one. All right, and none of that was what we were looking for, but just to give you an idea. Oh, there you go. That's the day we hit 1 million cases, and now we hit 1.3 million cases the other day. That's some horrifying numbers. Okay. La, da, 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 da. Nope. Damn it. I don't know. Does anybody know what day I'm talking about? I don't see any. If you do, tell me. I could have sworn that was when it was. Ooh. Oh, no. That was just, what is it? The dividend portfolio. Well, I'm telling you, I mean, there's a lot of trade ideas in this freaking thing, isn't there? You know, and again, but my original point was I was saying, all right, well, you know, this isn't what I was looking for, but you have to think about what do you want to buy? You don't want to buy something that went from here to here. You want to buy something that went from here to here, and then you say, well, what's wrong with them? Why are they at $8? No good reason. This trade here has a 41% upside potential, but you can make a better trade than that out of this. Take two also, the REITs, both the REITs went down because of rate fears, which are silly. Wow, look at VTRS, really took off, huh? So that one had a 43% upside. This was oh, this is 1.5. So this was January. So this is from January 5th. Where are we? Oh, so this was from January 5th, and it really took off since then. So we had 9,000. 9,000 of upside potential, right? Here's Dow is doing well, and that had 129% upside potential at the time. That's after we'd entered it. Here's Frontline, and this is from, again, like I said, this is from January 5th. So Frontline's from here. Pets is still languishing, so you can still get into Pets. It has 129% upside potential on this trade. Nothing wrong with that. What is our Pets trade? La 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 la. Pets. Oh, here's Pets. Oh, we're not even covered. Yeah, so we have to cover that at some point. So that's a pretty simple one. Did I say anything about covering it? Nope, just blah, blah, blah. Okay. Aggressive, I'd like to sell a 202 435 calls, now 330 for about $6. Well, that sure as hell isn't happening right now, so we're still waiting. And here's AT&T, of all things, with 73% upside potential at 30 from here. So we were here, and we're talking about a 73% upside potential if they get back to 30. I mean, they're just stupidly cheap. I don't know where those, I apologize, I don't know where those other stocks were. I had a whole big list. It wasn't these guys. La 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 la. I don't know. Oh, it's annoying. Swore it was on a Tuesday. It'd be great if I could remember. So it wasn't Monday. It wasn't. We looked at this day, didn't we? Yes, 1 million new cases in a single day. So we did look at that day. So I'm thinking it has to be the Tuesday after Thanksgiving, then would be my next choice. What portfolio was this? Oh, this is the money swap portfolio. That's interesting. Let's see how they're doing. Wow. So okay, so originally the money swap portfolio, I forgot what day I went on. Oh, December 1st, right? So what happened with, I was explaining the money to our portfolio. We added those trades we just talked about, the Hewlett Packard and I'm sorry, the new ones that we added. So this was the money to our portfolio. December 1st, I went on the show and we added IBM, Intel, Altria, and WBA. That's what we added to the money to our portfolio. So as of the end of December, so a month later, we were at 126.9%, 226,000. Now, of course, I haven't been on the show since, so we haven't touched them. And check this out, 241. So what's that, up another $15,000 for not even a month. I mean, in a couple of weeks, in two more weeks, another $15,000. That's just crazy. That's how fast things are gaining in the market. But again, it's because we made a lot of good trades. All of our new trades. WBA, look at the profit here. So whatever that, that's big. MO is up big. Intel, so profit. And IBM, tremendous profit already on those trades. And obviously, the rest of our stuff is doing well as well. Boyd is doing well. Gold is doing not well, but flattish. Hewlett Packard, fantastic profits on that trade. We've been doing, and SunPower. SunPower comes and actually SunPower is still negative. So honestly, you can still do this whole SunPower trade and still get. And then what I said, then Viacom is finally turning around a little bit. It's a nice little portfolio. And here we were prior to, what are we saying? On December 1st, money swap, blah, 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 trade ideas that featured on the PSW report. Yeah, so as of December 1st, so the status of the portfolio at that time was $200,000. We had the $32,000 worth of trades. And then we added the ones we were just talking about. We added the new trades, well, at the bottom here, and we altered SunPower. But we haven't touched them since. So we made these changes to our $100,000 portfolio. We added 4 new positions and made a couple of adjustments on December 1st. And since December 1st, we are up to whatever the hell it is. We went from 200,000 to 241,000. So $41,000 since December 1st in 6 weeks. That's pretty freaking good. And we still only have $81,000 worth of positions. That's another major thing, by the way. It's like, don't be impatient. Spend your money when it's worth spending. And that goes back to the same thing I was just talking about with those, with Costco and BJ's. Why spend your money on something that's not on sale? Doesn't make any sense. Buy things when they're on sale. Oh, meanwhile, we never got around to checking whether this Tuesday I have the extra plays. And what's funny? I talked about all this stuff, exactly what I was talking about. I said, how to get rich slowly. I was talking about the same concept here. I'm like, this is how this works. You do not have to do these things fast. You make plenty of money by being slow and methodical and being careful about your trading. There's no hurry. The market's going to be there tomorrow, no matter what you do. Oh, I totally give up. I'm so pissed. No idea where I put all those trades. A waste. Did anyone find them? Oh, you had a watch list including Generac ATV. When? It was December 30th. Ha ha. Thank you, Brendan. I appreciate that. Okay. So now we know where we're supposed to be going. December 30th. I knew it was after Thanksgiving. Yeah, I knew. No, I didn't know shit because I was look. Oh, look, it's right in the wrong place too. It was Thursday. But that wasn't Thanksgiving, was it? December 30th? Couldn't have been Thanksgiving. Oh, December. What am I talking about? Thanksgiving is November. December 30th. So it was ending the year. Oh, here we go. Oh, now I'm happy. So the December 30th Thursday is when we had it. And here's what we were talking about. So again, we're talking about like, what do we like to play? So why do I like things? So, it's I said we bumped up our hedges, which we've just done recently. So it's now again a good time to go back and look at these guys. But who do I want to buy? I want to buy the ones that didn't jump up since then. This was December 30th. I liked them down here. And again, look how shitty the charts are. And again, I hate TA. I think it's a complete waste of time. I have no respect for people who follow TA. But you'll see a lot of times I'll pick stocks at the very bottom of a chart, and it's got nothing to do with the chart though. I pick it based on the valuation, but I'm not the only value buyer. In fact, value buyers, there's very few of us left in the world, but the ones that are left have all the money. So it's like we wait for everybody else to get out, and then we come in. And that's why you see me pulling the trigger at these dead bottoms like this. I want to buy Baidu at 140. That's my price. When it comes down to 140, I get excited about it. So here we like Baidu down here. JD was down here. Now it wasn't all the way down. It was December 30th. It was over here at 70. But that's where I'm willing to put my foot down. 40% off its high. 65 is just 103 billion. That was my target, not 70 anyway. For companies on track, blah, 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 JD's logistics. So in other words, had they gone lower, and that we didn't pull the trigger, none of these are blue. Only one was blue. Generac is a generator company. Now these guys got a little bit cheaper. All right. We like them when they're down. 347 is 33% off. That's where they were at the time. And I love these guys, Generac, and they're fantastic because the more natural disasters, more people need this. Alaska. I was worried Alaska Air was going to get away. So on December 30th, I decided that we would play Alaska Airline. We sold the puts. We promised to buy 500 shares at 35, which, where's 35? Here's 45. It's going to be down around here. So by selling the puts, we sell the $40 puts for $5. 40 is still down here. So with the stock here on December 30th, we're promising to say we sell the $40 puts for $5. It brings us down to this net. And that's my entry on Alaska Air. Because I say it's my favorite airline. They don't lose too much money. If there's no more COVID, if Omicron was mild, then I want it to be in some kind of form of transportation. And this was the one I picked. So that one I considered like, what if it gets away from us? Activision is a gaming company. They've gotten a little bit cheaper. And did I have a number? No, I didn't have a number for this one. I was just saying if they come down a bit, I'm going to be interested. Be very interested. If they come back down here, this was a mistake not buying it here. Medtronic, I love these guys. Medical devices. How could you not love medical devices when everybody in the world is getting older? When the population is skewing way older over time. So again, we're over here, and I said I like Medtronic, and 104 is 23% off. And this is a great little company. And I said, as without, I would promise to buy them if they got cheaper. Can still do that. we don't have a burning need for any of these things, so we didn't race. We're not racing into it, but all good companies to play, all much lower than they were. Boeing is only 119 billion at 203. They're up at 218 already, so they've gained almost 10% since then. Again, I said we already sold the 202 for 200 puts in the long-term portfolio, and they're 30. They were 38 at the time, so we sold them for 30. They were 38. They're probably back to 38 now. And then that's even at 162, and again, it's like way off the charts down here. Oh wow, look at this. Philips 66. I wish I had remembered that one. Philips 66, 22% off its highs, right? Because we were here, and I saw the oil prices coming back and figured the refiners would start doing well. And I said next year they expect to be back over 3 billion, so now's the time to get in. And apparently somebody realized that. So meanwhile, they're gone. I've got no interest at all in buying them for 86. I was, at this price, I was happy. Boeing hasn't really gotten away in the grand scheme of things, so I'd still play that. But that's what you do. You go over this list. Say, did anybody get cheaper? I still like them. Did anyone get cheaper? Or did anybody not go anywhere since I picked them December 30th? Like Disney hasn't gone anywhere. I said Disney is off the highs, market cap, blah, blah, blah. Not really a bargain, and Omicron makes them too risky, but worth keeping an eye on in case we shut down again and they get closer to 120. So we already know what we're doing there. And here's Corning, which is GLW. They make a lot of the glass for your phones and things like that, and for iPads and such. Oh, and computer monitors in general, and TVs, I guess, also. So they make a lot of glass. So tech glass is what they make, and they're good for. So I said 20x for this is very fair. So I just think that's a good price, and they're basically around the same price. So this is another one, hasn't gone anywhere. Hasn't gone anywhere, and a month later we feel a little bit better about the market not collapsing. We just added a whole bunch of hedges, so that's the logic under which we may add some of these guys to the long-term portfolio. But like I said, only after we go through our changes and make a purge, which will be next week, right? Because the 21st is going to be the third Friday. And isn't Monday a holiday? Is it Martin Luther King Day or something? All right, so good. So now I know where these are. But you see, this is when you buy. You buy when it's on sale. I don't want the chart that goes from 100 to 140, and now you tell me I want to buy it. I want the one that went from 100 to 60. And you say, why is this down at 60 bucks? That's what you want to say. Why is Activision at $60? What is it that people don't like? It's $51 billion. They're making $3 billion a year. So, not 20 times earnings, like 16 times earnings, 17 times earnings. Yeah, they 17, so 17 times earnings. They are, if you look back, they did really well in 2020, of course, because everybody's stuck at home. So what are they with people playing games like crazy, right? They do have a lot of subscription revenue gains. They have an up and down cycle, but they're one of the biggest gaming companies, and they'll probably do very well with the metaverse. As soon as somebody has a hit metaverse game, don't forget, they don't have to invent the metaverse game. They just have to buy the company that invents the hit metaverse games. They've got the cash. They're a healthy company with a good amount of money on the books and so on and so forth. So basically, you want to look back at the prior growth. They went from 4.6 to 6.6 to 7 to 7.5. So they're good for about $500 million a year in growth. They pulled back for whatever reason in 2019. All right, but it didn't really hit them too hard on the bottom line. Then they went to 8 billion, big impact. I mean, going to 8 billion was a lot of that went straight to the bottom line. Half of the money went straight to the bottom line, pretty much. Now we come into here. They're carrying the subscriptions. This is what people don't understand. when they get all this new revenue, it's subscription revenue, and they carry a lot of it forward. It's not like they had one hit game and it fades out like it used to be. And again, it goes back to analysts are morons. They don't understand the companies they're analyzing. This company doesn't sell games at GameStop. They sell a login at GameStop, and that you then subscribe to the games. And a lot of people subscribe anyway. And they're on multi-platforms. They're on the PlayStations. They're on the computers. They're on the iPads, and they make money selling the in-game arts and crafts and tokens and things like that. They're getting into the NFT space. There's a lot of positive catalysts for a company that's only trading at 17 times earnings, and their growth is generally, more than 5% a year. Actually, it's 11.6% on the average. So but I wouldn't count the surge here. That's unnatural. You can't count on that happening all the time. But even from 8, they're building off of that. They're building off of that. They got 2.9 in profit. They expect to maintain their 2.9 profit. Why are they only selling for $51 billion then? What's wrong with this? Why don't people want that? Why do you want Costco at 40 times earnings when you could buy this instead? Not the same thing, but I want companies that make money. That's my goal. I want a company that's going to return a profit for my investment. And there's plenty of them. It's not like there are none and you have to go to Costco. You don't. Anyway, so just crazy money being made. I mean, these value stocks are catching up very nicely to the market, which is, again, the fun of being a value investor is when there's a huge rally, you get to poke around and find the bargains, and go and get the diamonds in the rough. And then eventually the market gets tired of chasing after the bullshit and starts looking for value. They look for value and you've already locked it up. That's the key to the whole thing. All right, so thank you, Brendan, for getting us back on track there. Now, let's see. Fed Beige Book. Let's take a look at the Beige Book, see what the Fed has to say. How's the market holding up? That'll tell us anyway. Charts. What happened? A little bit of a pullback, not too bad, nothing terrible. Oil's back to 82.50. Well, 82.70 is not really helping. Look at natural gas. Holy shit. Natural gas, I'm pretty sure we have it in the short-term portfolio, don't we? Because I know we were talking about that a couple of weeks ago. Oh yeah, UNG. See, back on 12/9. Is that a Wednesday? Thursday, yeah. So it's from something we talked about on Wednesday, Thursday. So here, and again, it's like so in the money already. Yeah, let's with UNG. So again, shit chart, right? But it's when you're a value investor, that doesn't matter. What matters is it got to the value. This is why I'm always buying at these bottoms of the charts, because I'm waiting. I'm not waiting for the chart to bottom out. I'm waiting for $12. And when we hit $12, now meanwhile, when we first hit $12, if the chart was like this, I'm not jumping in because the chart looks like shit and it's got momentum. But once the momentum starts, I say, oh, my $12 price target was right. And so on December 9th, which is around here, I say, oh, you know what? This is a great price for natural gas. It's stupidly low, and we want to get into it. So, and see, it was at 12. And so what's the trade? This is a key to the thing. No, not there, there. So at 12, what's the trade we make? We bought the 10-12 bull call spread. So I'm not betting that it's going to go higher. I'm just betting it won't go lower. And we were able to buy the $10 calls, which were in the money for $3, and sell the $12 calls, which are at the money for $2. And that gave us $1 on a $2 spread. That doesn't sound very sexy, but then we sell the 10, then again, because I don't think it's going to go lower, we sell the $10 puts to pay for the whole thing. So now we're in a $5,000 spread for net zero, right? Or a couple $100, 15 to 10, $200. So we're in the spread for $200. It's a $500 spread. And it's already 100% in the money. It's already up. Well, actually look at how much how is that even possible? 14, this is 4,000 and this is 1,000 profit. So there's actually more profit now than the spread would generate. Oddly enough. I imagine this is probably you can't actually get this price or something. I'm not sure. I mean, obviously, I would cash it out if you can get $5,000 for it. That's all. Oh no, I'm sorry, it's not. It's a $6,000 spread. No wait, no wait. Oh, I'm sorry. Duh. 10. It's a $10,000 spread. Still, we paid $200 for a $10,000 spread, and so far now it makes sense. So far it's up. Almost $6,000 already. So it's funny because people said, why are you selling the 2024 puts? Well, it's because first of all, I don't think it's going to go lower than $10 into 2024. So we never have to cash that out. Just because we cash this out as a winner and we would take $10,000 off the table here, okay? Obviously, you could say, yeah, of course, but we still owe some money on this, and therefore it's not really a $10,000 winner. Fine, who cares? Because that's just one of those puts that you sort of forget about until they expire. And also, we don't mind owning natural gas long, 2,000 shares at $10, because that's a perfectly reasonable price for natural gas. Then we could turn that into a bullish trade. So we have a plan within a plan within a plan to make money on this thing. And the bottom line is, though, we take $200 cash, and as long as $12 holds, which is a joke now, but as long as $12 holds, we're going to cash this out for $10,000 in April, which is now not very long away, 90 days from now. And we only started 30 days ago. So it's in 4 months, we pick up $19,800 of cash. And then we have the obligation that sits in the portfolio for a while, but who cares? It's just it's a trade we would have made anyway. It has nothing to do with it, other than it lowered the cash basis of the initial trade. So that's why 2024, you make plenty of money anyway. We already made $6,000 on a $200 investment. So you can't let yourself get thrown off by the time frame. We went to 2024 so that we could get $5,000 instead of, you know, maybe if we did January, we would have gotten $1,000. So instead of getting, so we got a lot more money in our pocket, and it's either way, it's the same trade. We would have sold the $10 puts either way. But this way, we picked up 2 years worth of premium. And if natural gas did go back to normal, and it did very quickly, where did that start? Nope. So if it went back to normal, which I consider normal more up around 14, 15, if it went back to normal, we would never have to worry about it. And all we did is bet that it won't go lower than 12, and that by April it will be higher than 12. Any number above 12 is a winner. And that's, again, don't care about the chart. These are fundamental investments. Has nothing to do with what the chart looks like. This is just the number where we said gas should not go lower. And in natural gas, that number was about, was it 350? Something like that. Yeah, so it was down around 350. And that's a number that we have determined that natural gas will be. Now, why 350? Because of liquefied natural gas being shipped all around the world, gas is no longer a US-based market. So if there's a surplus in the US it's going to get shipped out very quickly compared to gas used to be a local thing that was too expensive to ship. So if you had too much gas in the US, it could go crazy cheap. That no longer happens. Russia wants our, not Russia, Europe wants our gas. Other countries want our gas. China wants our gas. People will take the gas that we have now and take it out of the country. So we no longer have these massive surpluses that build up in natural gas production. And also our production has been limited, so we've got a lower supply. And the natural gas prices had tanked out because they were predicting a mild winter. And also the global shipping thing was causing a slight buildup in the US, but that was gonna, the bottleneck would come away and it would get cold in the winter like it usually does. And so that's what happened. All of a sudden everybody says, well, that was too much, and now it's coming back. But eventually, globally, I believe, and by the way, I said this, when did I make this call? Gas used to be $2 in the US, and I said we'd settle in at $4.50 globally. But I said this back when liquefied natural gas was first becoming a thing. I did these calculations. So like a good 10 years ago, like back in 2008 or something like that, is when I made these calculations. And I said $4.50 would be the correct price for natural gas. Over the longer haul. All right. So in other words, here when gas was down low and I had a crisis down around here in 2 and 212, and it kept bottoming out at 2, I always said $4.50 was the correct global price, and $4.50 line is right about here. So this is the correct price for natural gas, in my opinion, based on all the fundamentals of global shipping and so on and so forth. So when it's too high, it's too high. When it's too low, it's too low. And $6 is about right. So you expect the range should be from 3 to 6. Below 3, though, is ridiculous. Below 3 makes no sense. Believe me. They used to pay, when we would pay, and here's natural gas. Well, this is already monthly. So when we were paying like $2.50 for natural gas and $2 for natural gas, right? This was that, there was a bunch of silliness here with Enron and all that other stuff that happened. But normal natural gas prices are right about here, $3, $2.50 in that range. And when we were paying $3, Japan was paying 12, China's paying 10, Europe is paying 8. Because we are the Saudi Arabia of natural gas. We pump more natural gas than any other country by a mile. We have more natural gas reserves than any other country by a mile. So we always had the lowest gas prices. It was landlocked in the country. This is what led to people developing liquefied natural gas and putting unbelievable billions of dollars into the development of these terminals. They take years to build, years to come online, but all very predictable. We used to have a building schedule for this. We used to look ahead to see what the build would be and when it would come on, and when the ships would come on, and when the trains would be online to move the containers and so on and so forth and blah, blah, blah. So it was all just such a very predictable, wonderful thing. We've made a fortune on natural gas over the years, and now we're at the point though where we just say now it's more useful for us to say we know what it should be, and therefore we know when it's too low, we know when it's too high. But a lot of traders are stuck in the mindset of this old, crazy, volatile natural gas market. That's just no longer the case. So when you see it going like this, they imagine it's going to go back to 2 because they look at the chart and say, oh, 2's the bottom. 2's never going to happen again. It's just not a realistic price because it's different now. It's not what it used to be. Okay, so we're going to look up the Fed. Here's the beige book. All right. Now, remember, it's very important to read first of all, there are 13 districts, very important to understand. You have to look for the kind of language they use. When they say most, some, blah, 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 you have to look at the strength of the words. It's very subject to interpretation, but it's not really. I mean, they say things consistently, and the people who know how to read it know what they're saying. They don't want to say anything that can shock anybody one way or another. So they're very careful. So economic activity expanded, modest pace, final weeks. That's not the same thing as the final months. So possibly spinning it positively. Contacts from many districts indicated growth continued to be, growth continued to be constrained by ongoing supply chain disruption. So many districts, more than half, you get the impression, they would say some if it was less than half, many is more than half. Indicated growth continued to be constrained. So interesting, expanded modest pace context many districts. Also keep in mind that expanded is from the crap we had last year. So not very impressed by expanded at a modest pace. Despite the modest pace of growth, demand for materials and demand for workers remained elevated among businesses. Okay, we know that. Lending activity picked up slightly towards the end of the year, and again, picked up from horrible, led by commercial real estate borrowers. Consumer spending continued to grow, and we know about commercial real estate, like apartment buildings. Apartments are very in right now, making a lot of money. Consumer spending continued to grow at a steady pace ahead of the rapid spread of the Omicron variant, okay? Most districts again noted a sudden pullback in leisure travel, hotel occupancy, and patronage at restaurants as the cases rose in recent weeks. So in other words, by December, it was starting to look like a big problem. Here we are 2 weeks after the end of December, and everybody's acting like there's no problem. This is completely incorrect. And I can tell you from observation, I just came back from Orlando. Orlando has certainly been impacted by this thing tremendously. Very surprising how many people are actually avoiding travel and so on and so forth. It's odd. But I guess the reason for it too is because you don't have a choice. I mean, people are getting, Jackie got COVID on Christmas Eve. Well, didn't get COVID, was diagnosed with COVID on Christmas Eve. She got COVID a couple of days before. She was sick, and on Christmas Eve she was horribly sick. She went and got a rapid test, and it came back positive. And the next Tuesday she took a test and was told on Wednesday that she was okay, and she flew down to Florida on January 3rd. So but literally up until the last minute, I mean, she was waiting for that result to come back the week before, and that came back positive. If that had come back negative, she would have had to cancel this trip. And also would have sucked. So, and even so they flying, and it's all ridiculous because everybody's wearing masks that don't actually do anything against Omicron. It's a game, and today there've been articles in the paper saying everybody will get COVID. Everybody's going to get this thing. It's completely contagious. It's out of control. 1 million plus people a day are getting it now, and that's going to double. 2 million people a day are going to get it. 4 million people a day are going to get it. It's not going to just disappear. It's all wishful thinking. 100 million people are going to get this thing. That's many, many millions of people from now. And 100 million people are going to get this thing by the end of March. So we're at the early stage of a real disaster. And not, and again, it's mild. Yes, it's mild COVID, which is still a bad flu. And a bad flu hitting 1/3 of the population is not a good thing. It's going to impact productivity all quarter long. Although optimism remained high, generally several districts, that's some, report from business expectations for growth over the next several months have cooled somewhat. So business expectations have cooled during the last few weeks. Manufacturing sector continued to expand with some regional differences in the pace of growth. Overall activity in transportation expanded at a modest pace. Farm incomes were elevated to 2021. Conditions were marred by drought conditions across several districts. Okay. Employment grew modestly in recent weeks, but context demand for additional workers is strong. Job openings were up. Overall payroll growth was constrained by labor shortages. And we saw that in the non-farm payroll report, which only had 200,000 jobs added, which is not at all what you expect out of coming off of so much unemployment. And yeah, to some extent we've run out of workers. That's a big problem. But to another extent, it's just good jobs aren't being created. And I'm sorry, because they're raising minimum wages. But now when you consider inflation, and you try to tell me how a person anywhere where people are still being paid $15 an hour, these are the employers who are saying you can't find anybody to work. Yeah, you can't find anybody to work for $15 an hour. It's ridiculous. And I'm sorry, that's not even really the minimum wage. But $15 an hour, 40 hours a week, is $600. That's $2,400 a month. And $2,400 a month is just under $30,000 a year. They're going to take maybe $7,000 of that out in taxes and crap. That leaves you with $23,000 total to spend, which is about $2,000 a month. And that's what you have to live on. That's what you got to pay your rent and all your food, your phone, your entertainment, so on, your clothing, your medical insurance. Where the hell are you going to do that? It's not a job if the person who has it can't afford to live. My daughters and their friends in college are taking jobs that pay $15, $20 an hour. They're like, what are you supposed to do with this money? This doesn't help at all. It sounds like a lot, but try to do the math and think about people working, these kids working part-time, 15, 20 bucks an hour. They put in 15 hours a week. They got $300. It costs $15 for a drink at the bar. Not that they should be going to the bar, but besides, a drink is $15. An appetizer, you guys go to restaurants, an appetizer is now $15. There's no $5 appetizers anymore. Desserts are $10, $15. I'm like, who the frick is, how do regular people do this? It's crazy. And I can see how they're doing it because I see it when people are eating, they share their meal. You know, but we still get stupidly large portions in restaurants, so people are just sharing their food and taking a half a meal each. But people are cutting down on stuff, and that's why also you got to look at these companies like Netflix and so on and so forth, and they're not all going to survive, or they're not all going to keep growing the way they've been growing because people are starting to have to cut back on stuff like that. People have to look at those credit card bills and say, I got to cut some stuff out of these. I can't every month pay this money. You know, and it's kind of a good habit. It makes you realize how depression kids are. Like my grandfather was a depression kid. Both my grandparents were, and they were depression kids. They grew up around that time. My grandfather was my grandfather Max was born in 1903. He was the oldest, but Grandma Dinah was born in like 1908 or something like that. And Uncle Henry was born he was the youngest, so he was born like 1912, 1915, something. So they were alive during the Depression. They went through that time, and they have very good money habits. Or you think of when we were younger, we thought they were like really super cheap or whatever, but they have good habits with money. They're careful with cash, and they make sure they hang on to their money. This is something my kids I'm seeing are learning, which is really interesting because I'm watching them, and how they spend their money and what they do with it and how they save it. Like Jackie, God bless her, has a huge amount of money in the bank. She just, she works. We give money to live on. She works, but she is very careful with that money. She does not go crazy, even though she lives in Hoboken and goes to the city and stuff. She does a really good job holding on to her cash, and she's investing some of it and doing stuff and putting it away, which is fantastic. But they're very conscious of how much things cost. They don't go running out and spending like we used to. So tightness in the labor market drove robust wage growth nationwide. Some districts highlighting growth in labor costs associated with non-wage benefits. Oh, that's interesting. Non-wage benefits. So the employers are starting to have to offer benefits again. For 20 years, they've been taking them away. Now they have to put them back. Many contacts noted wage gains among low-skilled workers were particularly strong. Compensation growth remained well above historical averages across industries. And worker demographics across Europe. Besides wage gains, many contacts indicated adjustments to job demands, such as accommodating part-time work or adjusting. Yeah, people are getting more flexible with their jobs. They're allowing people to work 4-day weeks. They're doing whatever it takes to get someone to come work for you, basically. So it's interesting how you see all this fighting that had been going on for so many years when the employers had the upper hand, and they've completely lost the upper hand. And it all started really, this is the fault of the Republicans, frankly, because it's the Republicans that cracked down on immigration. It's the Republicans that stopped all these people. We used to have 1 million+ people a year entering the country looking for any kind of job they could get. And we said no mas to that. So all of a sudden, millions and millions of people are not entering the workforce, and now you've got to sit there and figure out how you're going to get everybody else, all these Americans, to come in and work and do your jobs and pick your grapes and whatever. It ain't easy, because we have to live. Because we don't live like that. We don't live with 8 people in a 2-bedroom apartment. We're not willing to put up with those conditions, and that's what makes it tough. Who was I talking to? I was talking to one of my nieces in Orlando. She was talking about they shared a bed. She didn't share a bedroom. She shared a bed in an apartment. That's how much they're consolidating. So they have too many people. I think they have 6 people in a 4-bedroom house, and she and this other girl actually just share a bed. They got a king bed in the bedroom, and they both sleep on the same bed because they like that better than having 2 separate beds. And they're just all, and still it's some crazy amount of money per month, like $800 a month for them to live in this place, because the prices are just out of control for rents. But that's what happened in the Depression, right? In the Depression, a lot of people turned their houses into boarding houses. And you would have 10, 12 people living in a house that would usually have a family of 4. And people would just sleep in all kinds of places and be shoved into the house, and they'd all get together and have an inexpensive supper together, and so on and so forth. Circumstances cause this sort of thing. You're driven to economize by circumstances. The problem is, as we know from going back to my grandparents, once you kill that consumer behavior, once you instill that mindset, it's very, very hard to get those people to start spending again. Because one of the reasons that they had advertising in the 50s and 60s, and advertising really started after World War II as being a big thing in America, they had to try to get these people to consume. They weren't in the habit of consuming. And it took a lot of advertising, a lot of incentives to get people to start consuming. And that's going to be a problem. If we destroy the demand, it's going to be very hard to ratchet this society back up. So prices. Contacts from most Federal Reserve districts report solid growth in prices charged to customers, but some noted price increases had decelerated a bit from robust growth. Wholesale material prices contributed to pricing pressure across a wide range of industries, spanning service providers, goods providers. Many contacts attributed the high cost of inputs to supply chain disruptions. Now, see, this is interesting. Many people attribute the high cost of imports to supply chain disruptions because that's what they're being told in the media. That's what Powell is saying. They're saying that this is all going to go away. It'll all magically roll back. Everything you're being charged now, the guy's going to call you up next month and say, you know what, I'm getting my shipments now, so I'm going to lower the prices. Don't worry about it. That's going to happen. No, it's not. That never happens. not only that though, but the stickiest thing, once you raise wages, it's over. And you have to look worldwide at what's happening. Worldwide, wages are going up. This is a worldwide problem, although exacerbated in America by a lot. But globally, wages are rising. And once you start paying people, you can't roll that back either. And then that creeps into the cost of everything. Not only that though, but the accounting for climate change and becoming climate sensitive in the way we produce things is going to add a very large price tag to things permanently. So the problem is people have the forward-looking expectations of inflation to be calming down. There's no sign of that happening at all. It's a fantasy. The pain is going to stop is a fantasy for now. There's no concrete evidence of that happening. And that's the problem with what Powell is saying yesterday. Powell's saying, oh yeah, we can tighten and it's not going to affect anything and the economy is going to be fine and nobody's going to care. It's like bullshit. It's all bullshit. They haven't been right yet. They really haven't. They've been saying stuff for 10 years, 12 years since the last economic crisis, and they haven't actually been right about anything that they've said. They stumbled from crisis to crisis to crisis, and they promised it would get better, and fortunately it more or less did, but not really because of anything the Fed did. The Fed has been floundering around and handing out free money for more than 10 years, and they've accelerated the pace of free money to the absurd, and their balance sheet is beyond absurd, and that obviously helped stimulate some things, but it led us to where we are now with a massive inflationary environment, and they think it's going to magically go away. It's not. So that's where we are now. So it's not temporary, but that's the narrative, and everybody still believes it. So that then causes your forward forecasts in a CPI model to be lower than they should be because of the people who they poll are being unrealistic. So then the government gets to point to the CPI and say, see, forward expectations aren't high for inflation. So it's because you keep telling people not to expect inflation. Not because they don't expect inflation. You told them not to expect inflation. It's just circular bullshit. You have to realize that when you listen to these things. Some districts reported that transportation bottlenecks have stabilized. The procurement costs remain elevated. Again, the procurement costs remain elevated. Why? Because the transportation bottleneck, by the way, oh my God, if you want to be a truck driver, you can get any amount of money you want for being a truck driver right now, especially truck drivers that don't go home at the end of the day. Long haul truck drivers right now, they cannot get enough of them. That's the biggest bottleneck we still have in the supply chain. And they are offering crazy numbers for those kind of people. So if you feel like hitting the road, that's the way to go, to get somebody to sit in the car and just drive around the country. Ongoing labor shortage associated wage growth also added cost pressure to business, right? Then highlights by district, I don't care. So, okay, so there's no real surprise in the beige book. There's nothing here exciting. Things are what we think they are. We're still in a strong inflationary environment. It's not going to abate very quickly. And at the moment, the market doesn't seem to give a shit. Certainly not based on it. 15,899. Well, we're down 100 points on the NASDAQ from where we were earlier. As I said, 2,200 on the Russell is the line to watch. We failed that again. That's not a good sign. Failing 16,000 is not a good sign. And the S&P is still 47.15. Where were we this morning? No, it's not the S&P. It's the NASDAQ, 15,840, right? So the NASDAQ, 15,840. So we're clearly above 15,840. So that's going to get a green. So we actually, on the whole, nothing else changed. So we made progress today because this has turned from black to green. We are clearly above 15,840 now, 15,913. So this is a win here. We now have all green except the strong bounce on the NASDAQ, which is 1605, which just failed, and the Russell is at right around the 22. Right, the Russell is very close to the 2200 line. Not, yeah, it's above, well above 2144. So the Russell's in between. So if all these go green, you got to be back to making bullish bets. That's when we're going to pull the trigger and start buying. Whatever we still can, we'll start buying some stuff and adding longs to the portfolio because we're back to a bullish bias. You have to have a bullish bias if everybody bounced over. Now, if you want to be strict about it, the NASDAQ should be recalculated because we had a draft. We don't recalculate all the time, but when you have a drastic move that's different, you do. And so 16.5 isn't really the bottom of the NASDAQ anymore. The NASDAQ, So, well, I mean, clearly, I'm sorry, it wasn't 16.5, it was 15,675. So 15,675, and we actually dropped much closer to 15, but you'd have to call this 15.5. So realistically, and we hit 15.5 here, we hit 15.5 here. So at this point, we would really look for 15.5 for the bounce line. So it's 1,500 points down. A 20% bounce takes you to 15.8 and 16.1. That would be the real difference there. Is now the lines were 15.8, so that hasn't actually changed. 15.8 is still the weak bounce line, but now 16.1 is the strong bounce line, and that really should be taken into account. So next time I do this, I will change that so that we're 16.5 to 15.5, and it'll be 15.8 even is weak and 16.1 is strong, because the 1,500 point drop gives you a 300 point bounce and a 600 point strong bounce. So it's all the way up to 16.1. So that lets you know. So that then indicates if we can't get over 16, that's extremely bad for the NASDAQ. And if the NASDAQ is bad and the Russell is bad and the Dow is a meaningless index, then it's really only the S&P that's disagreeing right now. And the S&P is disagreeing very strongly. It's up at 4.7. So the S&P is way over this target, but the S&P has been strong. And as we noted a week or so ago, it has very narrow leadership, though. There's only 4 or 5 stocks driving the S&P, like Apple, which is currently looking like this. So Apple has gone from 140 to 175 now, which is 35. What's that, 20%? Apple's had a 20% run since October. So that's been a very strong stock and very strong for the S&P. But I think we talked about this, right? Because I said that we're going to have to retest, and we already did. We just did the other day. We're testing the 50-day moving average now. That's a 50. This is a 200. If we fail at 50, we could go all the way down to the 200. That would be tragic looking for Apple. It's not likely to happen. They're probably going to have some really strong numbers for the last quarter. So if that's the case, then we'll see where they settle out. But they'll probably settle out right around this range and consolidate here for a while. Then when the 50 and the 200 start catching up, they'll be ready for their next move higher. And that's where we are. All right, so that's all the excitement we have, and we're going to wrap this up. See if there's any major questions. Steve says, since the STP value has been going up as the LTP goes up, doesn't this mean it's not functioning correctly to hedge? No, come on. I mean, we hedge the hedges. So, it means that the combination of positions we sold are doing well in the short term. Okay, you don't have to lose money on your hedges. We construct our hedges in very strange ways so that there's some advantage to us in the short term. So in other words, we sold, and again, this goes back to, we sold these March $12 calls. We sold $10,500 worth of March of calls. They're down to $14.50. we make money on those short-term things. These January 130 puts on TQQ, okay, we're 94% profit on those. On TZA, well, we don't actually in TZA, we didn't do that. And then of course we had a correct call on Chipotle where we made a lot of money, and we had a correct call on UNG where we made some money, and we have a correct call on, there was another one, oh, Broadcom. Oh, look how much Broadcom came back. Because we were getting killed on Broadcom, and that came back nicely. So actually, we rolled that. That's why it came back. But still, we're not as bad as we were, basically. So what was I going to say? Oh yeah, and Netflix, we have we have a winner here. So we have counter bets inside the short-term portfolio. We try to offset with things that will make money in the market that we think it will, especially like if there's an opportunity to make money. And you make 10 here and 10 here and 10 here, and it offsets a lot of your losses. And that's the trick to the short-term portfolio is actively managing it and making money when you can. It doesn't mean it's not functioning correctly. Mathematically, it functions correctly. We know exactly how much money we're going to make if the market drops 20%. That will change a lot of this dynamic. But the big dynamic that will change is this portfolio can blast well over $500,000 very quickly if the market drops sharply. So yeah, there's nuances to the short-term portfolio. It's not just a mindless hedge. That's why you see all these different things. Here's a short call on Netflix. Here's a short call on SQQ. That by the way is expiring, fully in the money. Here's Wayfair, the 150 put. Oh, the 150 puts were much worse, and those are coming back nicely for us, so that's good. No. What am I talking about? It's down 16%. Yeah, that's definitely better than it was. And like I said, Broadcom, Chipotle was very nice for us. We counter bet. We bet against ourselves. We bet back. We sell short calls against our long positions. All intelligent things. We're selling premium. Same thing we always do. We sell premium. We know it's going to expire. Yes, it hampers our overall hedging, but when you're in a market that never goes down, you have to take that into account. You can't just mindlessly only take the direct hedges. Otherwise, you will always be opposite. We're smarter than that. We don't need to do that. You're looking at a very simplistic view, and I do understand that most people who teach you about hedging will tell you the most simple thing to do because they're lazy, because they don't understand the complexities of what they're doing, because they don't sell premium. Almost nobody sells premium. We're one of the only people on the planet who teach you to sell premium on a regular basis. And I've been doing this for 15 years now. And I was doing it personally before that. I started teaching people to do it 15 years ago. I still can't believe how few people do it. I really can't. It's the best system in the market by far. I do not understand the way other people try to do this. And most options people just have the worst habits. Most of these options, newsletters and things, they tell you to do the most garbage trades. And the only one out there that does a decent job sometimes is Tasty Trade is not so bad. They tell you some good stuff. But almost everybody else, including the Jerry and I, really disagree with what they do. Really, really strongly disagree. Anyway, on that note, let's wrap this one up. And we will do this all again next week, all right? And Steve, best thing to do is to go back in our, go back to the portfolio review, which is at the top of our, up here in the portfolio reviews. If you go back and look at the short-term portfolio reviews over the last year or so, and you'll get an idea of all the adjustments and all the changes that we make in order to sort of stay on top. So in other words, yes, we're losing money on our main hedges, but we're making money on a short option leg. We're making money on a side bet here and there, and we're very careful to construct these bets so that they're going to go against. So when we're losing money on our hedges, we'll make money on the other thing. That's basically the goal of what we're doing. All right. Thank you, everybody, for coming, and we will do this all again next week. All right. Take care. And I think Monday's a holiday, isn't it? Let's check that. There's like no holidays. It's such a bad year for holidays because they screwed us on New Year's, right? Martin Luther King Day, Monday, January 17th. So Monday is a day off this week coming up. So what do we get off? I remember it was like, yeah, look how few days we have off. Martin Luther King, Washington, Good Friday, Memorial Day, Juneteenth. What? What? Where the hell did that come from? July 4th, I know about. September. I know what I know Juneteenth, but I mean, when did that become a national holiday? Did I really? I didn't realize it was going to be a serious actual thing. Okay, that's fine though. I mean, it's nice to have it. June, look at May, June, July. We had a lot of wait, April, May, June, July. What's wrong with March? March is my birthday month. Why can't March have a holiday? Wow. Okay. Labor Day, September 5th, and November. So then we have wonderful, like every month we have a day off for the first half of the year, and then it kind of falls apart. That's not right. But anyway, so the main point is Monday is a holiday. Okay, so that's very important for everybody to know. All right, thanks for coming, everybody. Talk about it. We'll do it again next week. Take care.